Good morning, everybody, and welcome to this webinar hosted by Nedbank Private Wealth. I'm Bruce Whitfield, and thank you for having us in your homes. It's a huge day. It's a wonderful day. It is a day where a cold front has hit the country, so I hope you're wearing warm slippers. You've got a nice warm drink, because for the next 90 minutes or so, you're going to have your minds expanded, courtesy of Janca Steenkamp. Janca is a strategist at Nedbank Private Wealth, and the independent analyst JP Landman also is going to be speaking to you this morning. My name is Bruce Whitfield, and it's my pleasure to be your master of ceremonies this morning, and I'm going to be taking you through today's proceedings. Now, the world has changed fundamentally in the last couple of months, and we all know that we've been sitting at home in very, very difficult circumstances. Many of you, of course, in very comfortable homes and in great environments where you can work and you can live and play. Not everybody has had the same, of course, the same experience. It's been a very, very difficult time for the vast majority of South Africans as we now sit in stage 3. I nearly said of load shedding, imagine that. But yes, we're sitting in stage 3 of lockdown, which does mean that the vast majority of us are able to go out and do some kind of work. However, the economy is massively constrained. So the best estimates put the contraction this year anywhere between 8 and up to 16% if we go into another hard lockdown, should it be necessary to do so if we see an unprecedented spike. I've used words that I promised I wouldn't, but a big spike in COVID-19 cases once again. But where we sit in South Africa right now as a country, politically, economically, socially, is in a very dangerous and very tenuous space. I do ask you to remember, however, that we are very fortunate as a country. Imagine just for a moment, if you would, and I don't mean to give you nightmares, if Jacob Zuma was the president of the Republic of South Africa, just how differently this crisis may have played out. We have seen a mashup in Brazil, and they are in an epic crisis mode in terms of the way in which that crisis is being mismanaged there. The UK has had a disproportionate number of deaths because of its failure to respond adequately, and certainly in the United States, there's plenty of criticism of the Trump administration and its approach to COVID-19. But we are in the midst of a global pandemic. It is the first of our lifetimes. It is a challenging and really difficult time, but it is also a time of incredible opportunity in the world. I'm talking to more and more chief executives of medium and large-sized companies who are salivating at the opportunities that they see presented for themselves. Mr. Price, for example, is going through the process of asking shareholders if they can do a capital raise. For what, we don't know yet. They've denied that they're keen to buy Jet out of the Edcon group, which is in business rescue, of course, but they will pounce and they will do something locally in South Africa. I've spoken to executives of many companies who are very keen to do deals because suddenly asset prices are looking incredibly attractive. As far as equity markets go, we all had that sharp shock in March, of course, where the bottom fell out of equity markets around the globe. We've never seen anything happen quite so quickly. We've never seen anything happen quite so fast. And it was absolutely terrifying. But the recovery, too, has been nothing short of extraordinary. Now, opportunity, of course, there's an advert on the radio at the moment for a company that says, you know, good times are fine, but bad times lead to a different way of thinking. And perhaps that's precisely what we need. Certainly, Sir Isaac Newton is reputed to have gone on a holiday from Cambridge during one of the many plagues during the 17th century in the United Kingdom. And while he was at his parents' house, he noticed the apple falling from the tree and went, gravity, that's what that is. Well, if you look at the NASDAQ, for example, it is proof that the laws of gravity don't always hold true, because at least on the NASDAQ, the apple keeps on going up and up. This week, we saw the NASDAQ hitting 10,000 for the first time ever and maintained those levels last night, where markets this morning certainly are under a lot of pressure. Which leads me very neatly into your first speaker for this morning, and that is Janca Steenkamp. Janca is a strategist at Nedbank Private Wealth, and she is going to be speaking to us for the next half hour or so. Note your questions, because she will be taking questions with JP at the end of this session. Janca Steenkamp, it's over to you.
Good morning, Bruce, and good morning, everyone out there. I must say, I do miss the temperature control of an office or another venue. Good morning, everyone, and thank you very much for joining us today. it is often said that the only constant in life is change. But the speed and scale of the change that we've had to deal with this year, and the fact that we've largely had to navigate this crisis through human intervention and decision making, has left us with quite a number of firsts to reflect on. In December, January, we reflected on and marveled at the fact that China was able to build hospitals in a matter of days as they started to deal with a new respiratory disease called Covid-19, or the coronavirus. By March, this had escalated into a worldwide health crisis, with countries like Italy and Spain showing us the severe impact that this epidemic could have and its ability to overwhelm our healthcare systems. Today, the contagious disease continues to spread across the world, creating hotspots as it moves between countries and seasons. Now, the world responded in the only way that it knew how. At the start of March, the World Health Organization declared this outbreak a global pandemic. By the end of March, most of the global economic hubs were in lockdown. What makes this unprecedented and absolutely extraordinary is the simultaneous demand and supply shock that was imposed on economies on a global scale. If we look at economic activity indicators, which above the line shows us expansion and below the line contraction, the absolute collapse in demand and supply and the impact of the sudden stop is very clearly illustrated, showing contraction not seen and much, much worse than the global financial crisis, which you can see there on the left. And if we go further back in history, much more likely resembling that of the Great Depression. And more importantly, this contraction wasn't only across manufacturing. Indeed, it also extended to services. Now, manufacturing had already been struggling after a tumultuous year in 2019 of trade wars between the US and China. But services has always been, and for a long time, been the bedrock of many economies, including some of the big global economies like the US and Germany, where it makes up about 70% of economic activity. Now, it is therefore not entirely surprising that we also saw measures of volatility such as the VIX hit historic highs, the highest level in the history of this series. But it wasn't only the uncertainty that the markets had to deal with. There were also a few other things happening in the background and a few other firsts, such as a negative oil price. Now, you may ask me, how exactly did we get to a place where oil producers were willing to pay a trader or investor to take inventory off their hands? Well, let's reflect on it. International travel all but came to a halt. Borders closed around the world, and about a third of global oil demand all but disappeared in a matter of weeks. And therefore, the big oil majors, the OPEC members, met in Vienna with the intention of doing some production cuts. Now, oil is very much as much about politics as it is about anything else. And when Saudi requested production cuts that would stem the decline in the oil price, Russia declined, instead seeking to increase their market share that they had lost to some of the US shale producers. Now, Saudi didn't take this lying down. Instead, they increased production at a lower price, leading to a worldwide panic that we would be facing an all-out price war between these two majors. The oil price dropped by about 30% and got to levels that we last saw during the 1990s. Now, subsequent to this, in April, the OPEC members did meet again and did agree that they would cut production by an estimated 10 million barrels a day. Now, that represents about an average of 10% of annual supply. But if we compare that to the about a third of global demand that had all but evaporated, we shouldn't be surprised that the world was flush with oil, with a lot of excess supply floating around and having to be stored somewhere. And therefore, on the 20th of April, one particular nuance happened, one particular event happened. So the first futures contract, or the near month contract of the US benchmark for crude oil, the WTI contract, went negative. Now this contract does have a very specific nuance where it requires physical delivery of the oil, which typically happens in a place called Cushing in Oklahoma in the US. But it became very clear at the start of April that Cushing was probably getting a bit full and was very close to capacity, and all other storage facilities were similarly getting quite full. All of this left traders scrambling to get rid of the first futures contract, which actually saw the price of that contract intraday getting to -40 on the 20th of April. Now, I'm sure most of these guys were very concerned that they would actually have to deal and sit with a barrel of oil in their living room, and that is why we got to the -$40 for this. But the business community has also had to deal with a lot, and if we reflect on the feedback that we got in the earnings outlook and company results of the first quarter, it echoes a lack of visibility. We saw a lot of CEOs and companies withdraw forward guidance and really go into preservation mode. And all of this really, given the fact that they weren't able to know when they would be able to resume trading again. And all of this points to one thing: an environment that is highly uncertain, not only in terms of operation, but also in terms of timelines. And it's therefore not unsurprising, if there's one thing that the market likes less than anything else, it is uncertainty. And as Bruce said earlier, the moves that we saw in the financial markets were swift, they were brutal, and they echoed the volatility that we last saw during major historic market crashes. No part of the market was spared, and even your safe havens like gold didn't quite hold up in the month of March. The only place to find some shelter was in cash, and more particularly dollar cash. Now, the policy response around the world, and even here in South Africa, has also been quite unique, and also without moral hazard. So typically we would ask governments, why are you spending, and why are you increasing your debt in order to do so, and will that be productive? Now the question was, are you doing enough? The scale and the speed at which policymakers stood in has been absolutely unprecedented. And not only that, but it's also been coordinated. We saw central banks across the world cut interest rates as monetary policy stimulus in order to help consumers and businesses. And we also, at the same time, which typically doesn't happen, saw governments step in with fiscal stimulus which haven't been seen in previous crises. The US, for example, passed their largest fiscal package in history, more than 2 trillion rand, called the CARES Act, which, in also a very interesting move, not only supported businesses with loans and with money, but also did direct transfers to consumers. Now, they did more than that. They also provided liquidity to the banks and also made sure that the credit markets were functioning properly in order to prevent the same meltdown that happened during the global financial crisis, where markets seized up and companies didn't have access to capital markets. For those countries that didn't have as much fiscal room, the IMF and the World Bank stepped in and helped them provide safety nets for their people. And it was this whatever it takes message, and also low interest rates, that helped the world and helped the markets look forward. Of course, there was also the small element of things being on sale and valuations and prices hitting rock bottom. But nonetheless, markets looked forward. And if I told you in the middle of March that the MSCI would have its third best month in its history, just the next month after the anarchy of March, I'm pretty sure many people wouldn't have believed me. Even emerging markets, and in particular South Africa assets, looked forward and regained quite a lot of lost ground, despite being at the higher risk end within the market. But the reality is safety nets and low interest rates probably aren't the strongest foundations to build a recovery on. It has helped markets look forward, but the recovery has been fairly uneven, and the recovery in places like technology has been much swifter and has been part of the reason we've seen such a surge in global indices. And what remains concerning is that with prices continuing to go up and really, as Bruce rightly said, defying gravity, that cannot hold when your forward earnings and your fundamentals continue to deteriorate. And therefore, we have to delve a little bit deeper to see what's going on underneath the hood. Now, as the disease is spread across the world, lockdowns have eased, and we're now faced with this really strange and surreal situation where the do not disturb sign has been removed, and instead we've been told to go about our business, go back, be productive, but please proceed with caution. The unavoidable fact is that the world will face an earnings and a growth recession this year. And you can even go as far as saying that there is potential for a depression. In April, the IMF gave us a sobering outlook of what they believe the forecast would be for global growth. So they forecast -3%. And just this week, the World Bank came out and said, no, they believe it'll be -5.2%. What a difference a few data points and a month makes. The bottom line, however, is both of them painted scenarios where a second wave of infections or a longer recovery would delay this and worsen these numbers by even more. The other thing to also consider is that these numbers, although they seem small, are much, much larger than what we had during the global financial crisis, where global growth only contracted by 0.1%. And these numbers much more rival what we did see during the Great Depression. The other first which they highlighted, and which is particularly important for us, is the fact that emerging markets and developing economies would also shrink for the first time since they've been monitored by these financial institutions. So I've painted quite a grim picture. What does all of this really mean for us as consumers, as investors, business operators, and households, really? I think whatever letter you put on a recovery, the reality is this is not going to be a straight line. We've spoken about unequal and uneven recoveries. So let's unpack that a little bit further. Some of your biggest technology companies, Apple, Microsoft, Amazon, Facebook, which are largely familiar to all of us, make up about 20% of the S&P 500. And as I've said, have been a big proponent of the market re-rating. However, if we look at how much their revenues are as a percentage of US GDP, that only makes up 5%. We know that some services and some areas of tourism haven't even reopened yet. And so therefore, this recovery is unlikely to be a straight line. And it's also very, very likely that it's going to take much, much longer for us to get back to full capacity and some semblance of normality. And it'll probably only be when we find a vaccine or a treatment, a coronavirus treatment that can be distributed across the world. And the outcome here may be that we sit with this idea of a 90% economy for some time to come. And the great risk that we face as a globe is that this 90% economy remains for us for so long that it leaves scars such as unemployment, permanent or otherwise, businesses that don't survive, and an economy and a global economy that really struggles to recover. This is also evidenced by the experience we've seen thus far in China, where it has been much easier to reopen factories, and it's been much easier to get manufacturing and supply back up and running. But when the rest of the world is still in lockdown and you can't export and your local demand hasn't quite recovered, it does leave you in quite a precarious position. Over and above that, we have seen that demand, as indicated there by the dotted line in terms of retail sales, hasn't nearly recovered to levels of pre-COVID activity. Now, this is not unreasonable, at least in my opinion, because if you're uncertain about your local economy, the global economy, if you're uncertain about your job prospects, and if you're uncertain about your health, then surely that has to impact the way you think, the decisions you make, and the mobility, and the way in which you move, and the mobility in terms of your day-to-day. On a positive note, however, most of the central banks around the world have been very swift and decisive in terms of the actions that they've taken, and also created somewhat of a gift that'll keep on giving. In South Africa, the repo rate today is the lowest that it's been since its inception in its current form in 1998. The rest of the world, and especially the developed markets, were already very close to their zero lower bounds, and those that weren't have moved to that point in a much more swift way. And therefore, all of these developed market banks have largely opted for other forms of stimulus, such as quantitative easing, as well as asset purchase programs. All in all, creating what can only be called a floor, not only for markets and consumers, but for the economy. Only last night, the Fed indicated that we will be sitting with interest rates lower for longer and very close to zero for some time to come. And as I said, while the world recovers, this should at a minimum provide a floor for the economy as well as for markets. But each crisis typically has a weak spot or a weakest link. In the global financial crisis, it was the households, and in particular the US households, as well as banks. On this occasion, we see two areas that we're keeping a very close eye on, and two areas of vulnerability. The first of those is debt levels in non-financial corporates. So many countries around the world have used the low interest rate environment to increase their debt levels and have used that debt to do share buybacks, pay dividends, and in some cases for productive capacity. But if crisis teaches us anything, is that when the going gets tough, you don't want to be sitting with too much debt. The other area of great concern is countries and companies where they've potentially raised debts in markets where interest rates are low, such as the US, in particular in US dollars potentially, but their earning streams are based in local currencies. And this mismatch is a recipe for disaster when the US dollar keeps on improving and accelerating because of its status as a safe haven assets, and your local earnings in local currency continues to depreciate. Crisis also has a way of making the world pivot or to accelerate change. Now, many of you would have done a Zoom meeting or Zoom coffee of some sort during the lockdown, and so you will be familiar with this online video platform. However, what is absolutely astounding is that in the midst of this crisis, the market put a value on this company, which was as much as 7 of the major global air carriers. Now, arguably, that is a sign of disruption, and time will tell whether all of us get back on a plane again. However, it does make us and should make us ask questions about what the future will look like. Will we still be traveling as much for business or for leisure? Similarly, other trends which were potentially seen as disruptive in the past may be with us for longer to come. So on the right-hand side there, we can see the market capitalization or the value that the market puts on the company Tesla relative to General Motors and Ford, which we all know are some of the big, or well, two of the big kind of auto manufacturers in the world. Now, arguably, this is much more to do with the green economy and the future than it is about the quality of the different cars and auto manufacturing. It also has much more to do with emissions than anything else. And while there are various nuances here, it does tell us that some trends are likely to be with us for some time to come. Yesterday, for example, marked the first time that the US, not the US, the UK, sorry, was able to produce electricity for 2 months without using fossil fuels. Now, if we consider that paired with everything else, it is very likely that what we're seeing here is not only disruption, but structural change that is also likely to present opportunities across the world for the periods to come. Acceleration is also something else that crisis has a way of doing. If we think about the world post-World War II, we really were in rebuilding phase, and there was an international compact between different nations to try and achieve that. We moved supply chains, people specialized, we saw the rise of multinationals that were able to connect all of us and spread products across the world. Part of that also included the leadership of the US as part of this drive forward, both as a political and economic power. It is also true that in the last couple of years, some of that has been more disruptive. It's been disruptive partly because of leadership and politics, but there's also been disruption on the economy and the fact that China has been able to grow in the way that it has. The battles between the East and the West are likely to be with us for some time to come. And a slowing in globalization, or what many will call deglobalization, is also something we should consider, because as each nation looks to its own kind and looks to its own people and starts to rebuild their economies, create jobs, as businesses consider the vulnerability of their supply chains, and as each politician out there uses this crisis for their own means, it is not inconceivable that we will see an acceleration of these trends in terms of geopolitics for some time to come. Now, each crisis also has precedents, and as has already been mentioned in this call earlier, these are often the opportunities that come with uncertainty. In South Africa, there's a lot for us to consider. The old adage, never let a good crisis go to waste, has never been more appropriate and more urgent and pressing than it is for the country at the moment. If we consider the Stats SA surveys that were done at the start of the lockdown and then towards the end, it paints quite a grim picture. One of a weak economic backdrop, one that was already struggling with load shedding, with a constrained fiscus and mismanaged SOEs, and one where 55% of businesses said they wouldn't be able to survive more than 3 months of this lockdown, illustrating to us the limited ability to be able to build up buffers for the bad times. And more concerning is the fact that about 8% of respondents said that they had already permanently ceased trading by the end of the lockdown. And although that number may not seem as big and probably also represents the sectors that they polled, the reality is it is double that of what it was at the start of the lockdown. Now, South Africa's challenges are very well known, and therefore it was unfortunate but not unexpected that Moody's removed South Africa from its last investment grade rating in the midst of this crisis. Now, typically when an investment grade corporate gets downgraded, it is often called a fallen angel, and it'll put you in good company like Ford, for example, who've moved up and down the scale throughout the years, but still remains one of the biggest auto manufacturers in the world. And when you become a fallen angel and you're offering value to a new set of investors and into a new cohort, that does seem very appealing relative to the other opportunities within that sector. And therefore, at the midst of this crisis, South Africa's measurement of credit risk was at its highest that it has been for some time, exceeding that of Nenegate. Now, yes, I think we can all acknowledge things are tough and the risks have increased. And so therefore that is not unreasonable. However, what stands out is the difference between what we offer and what the rest of the value or the rest of that cohort and the rest of the world is offering. We have some of the highest real bond yields in the world, even compared to some of the other sub-investment grade countries. And so what is important about this? If we look at the Brazil example, after the changes that they've had a couple of years back, is one thing that comes to mind. Reforms are your biggest ally, and especially in times like this, and can provide a springboard for further investment, and also is one of the quickest way to get your interest bill down. So let's talk about a few opportunities that we do see locally across the asset classes. Now, unfortunately, I have to say that in the spirit of the times, all of these come with some health warnings. We've just spoken about the fact that in the midst of this crisis, South Africa's measurement of credit risk spiked. At the time, the real yields on offer were the highest that we've seen in decades. If we consider the fact that the repo rate is at its lowest in its history, in its current kind of stance, in its current shape, and if we consider the fact that the inflationary environment locally and globally is likely to be fairly contained for the foreseeable future, especially if we consider the low demand and lack of demand that we're likely to see, the real yields on offer is attractive. Now, we do have to bear in mind that, yes, when we looked at this in the middle of March, the real yields and the expected returns on offer were very, very appealing. Since then, the bond market locally has already rallied by 7%. And we also have to consider the risks embedded within this. So let me just be very unequivocal about this, and let's address the elephant in the room. We are very concerned about the fiscal status of South Africa. We're concerned about the trajectory and the compensation for the risk that we take here after the recent rally has become less. And as such, we're cautious holders of South African bonds within a balanced strategy, but we're certainly keeping an open mind with the next data point coming up, the budget later on in June. Be that as it may, it is worth highlighting that the one asset class that will pay you this year relative to equities, property companies, and various others is the SA government. Now, the property sector has also faced multiple headwinds over the last number of years. And if you look at some of the valuation, it does seem to extrapolate the fact that nobody will ever go to a mall again. There are a few things to highlight. One is a weak economic backdrop has caused demand-supply imbalances within the sector, which means that there is much more trading space than there are trading densities or footfall. An increase in operational costs, and in particular property taxes and electricity costs, has also eroded margins and also eaten into distribution growth for these companies. And it is not inconceivable and very reasonable to say that this sector is also very vulnerable to the structural changes that we've just spoken about, especially things like e-commerce, the move from physical to online, as well as the work from home trend. Having said all of that, we do see opportunities in select counters. If there was ever a stock picker's market, this was it. And there are a number of companies who have maintained very good balance sheets, have sought opportunities both locally and offshore that will put you in good stead should you invest at the valuations that they're offering today. Equities, both locally and globally, offered extreme value in the midst of this crisis, and we were able to take opportunities in both. Now, we've spoken about the fact that the headlines do hide a lot and do hide an unequal recovery between whether it's discretionary spend or not, but they do hide quite a lot. But if I told you that even after this re-rating, 85% of the JSE listed companies were trading below the averages of their long-term valuations, then you would probably agree that there are some opportunities to be had in this local market. Now, the health warning, and unfortunately the bad news. Many companies have already cut dividends or delayed them, and we may see more of that to come. Balance sheets in some cases should still be forefront of mind for every investor, and most companies have really gone into cash preservation mode. The earnings outlook is also somewhat unknown, and it is hard to tell exactly when we'll get back to normalized levels. And the other question we also need to ask is, what does normal really look like? For South Africa, we do face a challenged environment. For example, we've said that where a company is only exposed to SA and or South African earnings, we require a higher margin of safety. Each crisis changes the parameters that we put into models, and I would argue that actually many models in crisis times normally break down. But the reality is, even though the parameters and the inputs to the way we think change with each crisis, the principles that we apply to investments and the principles that we apply to investment thinking does not and should not. The price we pay today will determine long-term returns. But it is increasingly important today to focus on exactly what you're paying for. Are earnings just temporarily under pressure, or is there structural issues that may cause them to never return to the levels that we're used to? So it's very important to focus on exactly what are we paying for, and then decide over what time frame are we allowing things to normalize. And the reality is, time will be very fluid over the next while. In the midst of this crisis, we were able to reposition portfolios, move from floating rate instruments on the fixed income side into fixed rate instruments, locking in higher yields. We were also able to use cash to invest in global as well as local equities. All in all, however, portfolios remain balanced and, very importantly, very well diversified. Because the reality is that diversification is the one thing that gives you protection against a range of outcomes. And that's really the message that I wanted to leave everyone with. In the midst of this crisis, I often reflected at the ability of companies to pivot, to change their business models from delivering alcohol to delivering groceries. Locally here in my community, a local caterer now has Burger Fridays, where local community can support local business. And therefore it is right and it is appropriate for us to look at practitioners of change like this for signals and for insights into how to thrive in these periods of change. And I particularly like this quote from the CEO from Next PLC, which is a retailer in the US, from their trading statement in the midst of the crisis in April. Now, Next in the 80s was predominantly a catalog and physical retailer, but today about 50% of its sales come from its online platform, and it's been able to survive the demise of the high street in the UK. And I particularly like this last sentence, which says, our job is not to guess exactly how things will pan out, but to prepare the company for all outcomes that seem reasonably possible. So what does that mean for us, and what is our job? Our job is to consider all scenarios that are reasonably possible, to focus on the risks embedded within each of them, and to understand the time frames with which we make investments. And also to make sure that within each of these scenarios and what we consider, that we make sure that our portfolios are diversified. Because the reality is that change really is the only constant that we have, and that we may well have as a very predominant feature of our lives for some time to come. And we should prepare accordingly. Thank you very much, Bruce.
Janca, thank you very much. It's amazing, isn't it? I mean, change is the only constant, absolutely. And we must consider all possibilities. Boy, what were we considering in January this year? Were we considering COVID-19? No, we weren't. And this is the great time, of course. But we'll get on to questions, Janca. Quite a few questions coming through already this morning, and we'll get to those in the Q&A session with JP coming up in just a little while. Now, for those of you who are not familiar, cheers, Janca. For those of you not familiar with JP Landman, one of the strongest attributes JP Landman has got is that he is one of the few analysts in South Africa who takes a holistic view of what is going on. He is neither a political analyst or an economic analyst or a strategist. He is a guy who looks in every nook and cranny of South Africa to get signals as to what is really going on. In the early days, of course, of Ramaphoria, you remember those days of Ramaphoria. It was a 3-month period as Cyril Ramaphosa managed to oust Jacob Zuma and everybody felt terribly good about themselves. We then went into a period of Rama reality. That was a little less comfortable. That Rama reality taught us very quickly that this was not going to be a quick fix in the South African environment. And then we had a period of Rama, what the? And that was a period of like, what on earth is going on? But it was JP Landman who, through his meticulous research, was able to reassure South Africans that although the news headlines were inevitably negative and that the news flow was always negative, there was a huge amount going on in the background. And cumulatively, what we were seeing in South Africa was a slow, steady, positive progression. And that was an important message that JP Landman was delivering for the last 8 or 9 months or so. Suddenly, COVID-19 has thrown everything into disarray. And that is why I'm very keen to hear the perspective today of the independent analyst of everything, JP Landman. JP, to you.
Good morning, Bruce. Thank you very much. Thank you for that generous introduction. And good morning, ladies and gentlemen. And as Bruce has already said, thank you for receiving us in your homes this morning, and thank you for your time. Now, the title of this presentation to you is a political update. However, the real title is how deep are we in the dwang and how can we get out? How deep are we in the dwang and how will we get out? Now, what you see on the screen there with those large number of blue bars is South Africa's economic history going back to 1975. But it's a very particular history. It's a history of economic growth in comparison to population growth. I hold the view that economic growth on its own is not good enough. Wait, I'm told that we don't have slides. You just
exactly, JP. You do that, JP. You go and clap your computer as you're wont to do. Not too hard because we need it. And as you get your slides up and make sure that you are there, we go. We are all set to go, JP. Back on your own.
Thanks, Bruce. Thank you very much. My apologies for that. What you see on the slide is 45 years of history, all the way from 1975 on the left-hand side to 2020 on the right-hand side. Now, what do those blue graphs tell us? They tell us what happened to economic growth in every single year when compared to population growth. Some of the old Nedbank private wealth clients would have seen this slide before, and I still use it. And as I often say, I only work once a year, and that is when I update the slide. It tells us how many babies we're making, and it tells us how much cash flow are we generating. And you put those two things together, economic growth and population growth, and you come up with the slide. Now, I will explain that total of 6 years just now, but just take a look at the slide and you will see that there we are. In the period between the middle 70s and the middle 90s, South Africa got poorer. It lasted about 2 decades. It was not a good period economically for South Africa, although most people have forgotten that. Then what you see is that from about the middle 90s to 2014, we had a massive increase in per capita income. So in other words, economic growth was higher than population growth to such an extent that you could expand a lot of things which otherwise would not have expanded. You know, I often say to people, where do you think the property prices in the Western Cape, but the Cape Town, the Atlantic seaboard has come from? Where do we think Umhlanga has come from? Where do we think Sandton City has come from? Well, it has come from that 33% or 1/3 rise in per capita income that we saw over a period of about 20 years. The caption there, 25 lost years, simply refers to 1981, where you can now see my cursor, up to 2014 over there. And what happened was that in 1981, we reached a certain level of per capita income. The gold price that year was very high. South Africa was the world's biggest gold producer. That boosted per capita incomes. And we only again reached that level in 2014. There you see it. And that is what I call South Africa's 25 lost years. If we just kept on increasing our national wealth and our economy little bit by little bit every year over those 25 years, we would not have had many of the problems that we've got today. There is a price to be paid when you don't grow economically. As you can see, we then made up for it up till about 2014, which coincided perfectly with Mr. Zuma's second term as president. And you can see that for a period of 5 years, from 2015 to 2019, a period of 5 years, we got poorer by 3%. Now, 3% is not a train smash, but it's also not something that you can just ignore. You've got to deal with it, and the question is, how will we deal with it? And before we could recover from that 5-year decline in demographic, in what I call a demographic recession, we were hit by the coronavirus, and you can see there that for 2020, we will probably see a decline in per capita incomes of about 11%. Now, you know, the number may be 10, the number may be 8, the number could be 12. It depends what number you would like to choose. I use here the Bureau for Economic Research at Stellenbosch. They predict a decline in the economy of about 9.5%. You add to that 1.5% population growth, and you end up with a negative figure of 11%. And this, by the way, is worse since 1921. It is even worse than 1929. In 1929, per capita incomes fell by about 8-9%. In 1921, precisely 100 years ago, they fell by about 10-11%. So this is clearly the worst since then. We had a terrible drought in 1921, together with a decline in commodity prices, and that explained what happened to the South African economy. So how are we going to get out of this demographic recession, which, if we include 2020, will last a period of 6 years? What are the prospects, and how are we going to move forward? Now, the first point I want to make is the best way to do this is to judge on the track record of behavior of the government. Lots of people have lots of opinions about where the government is going and what they will do, and so on and so forth, and that's fine. People can have opinions. I think it's more reliable to look at the track record. And the reason is simply, you know, Warren Buffett said that, he said it several times, a forecast about the future tells you nothing about the future. It only tells you something about the forecaster. Therefore, be careful. Be careful. Try and stick to hard data as much as you can. And the hard data I want to look at is what has happened under the Ramaphosa government since he became president 28 months ago, and what has happened in the 13 months, really only a year since he has won his own election, so to speak, with quite a clear mandate. And I think the first point that stands out absolutely, and it was tested by the coronavirus pandemic, it was really put through the grinder, is that government is sticking with a stable macroeconomic policy. What is macroeconomic policy? Well, it's simply fiscal and monetary policy. The reaction to COVID was to bring forward or to table a fiscal stimulation of around about 7.5% of GDP against a contraction of, as we've already discussed, somewhere between 8 and 10%. So it was in all senses a proportionate reaction. The second point about that COVID-19 reaction by the government was that although it came to 500 billion rand in total terms, only 95 billion rand of that call it 100, call it 20%, will actually have to be borrowed extra from the financial markets. It was a very, very cleverly designed package. You take the 200 billion bank guarantee scheme. The banks, commercial banks, are in for 6% of the risk. The Reserve Bank and the government is in for 94%. But by using the balance sheets of the banking sector, you can free up 200 billion, and it doesn't have to come from the taxpayer. It was a very cleverly construed package, and it speaks to what I would call fiscal conservatism in the midst of an enormous pandemic. And then the other side of macroeconomic stability is monetary policy or interest rates, the position of the Reserve Bank, and really the Reserve Bank has held steady. They have not given in to any claims or demands that they should print money, that they should buy government debt, that they should drop interest rates down towards negative levels. A lot of claims or demands that have been made on the bank, particularly from what one can call the more left-orientated side of our economic debate spectrum. And none of that has been yielded to. You know, our memories are short, but precisely a year ago, in the first week of June 2019, we had 3 days, from Tuesday the 4th of June to Thursday the 6th of June, where Eskom argued in a public statement on behalf of the ANC that there should be what he called quantity easing in South Africa. He, of course, meant quantitative easing, and it was repudiated fully, completely, totally, and absolutely, not just by the Minister of Finance, but by the top 6 of the ANC. So much so that by the evening of Thursday, the 6th of June, Eskom put a notice on his Facebook page to say, from now on, this is our line of march. All ANC cadres, from now on, this is our line of march on the South African Reserve Bank. And it was in line with what we're seeing currently. So we've come through a downgrade. We've come through a pandemic. We've survived both those two really serious developments in a way where macroeconomic stability, both fiscal and monetary, have not been compromised. And that, I think, tells us something about where the government is. They tell us something about the intention. You see it also in the wage dispute. The civil servants are very unhappy that they're not getting an increase or didn't get an increase on the 1st of April. The matter is now in the hands of the courts, and we'll have to see what the judges decide. But certainly, you see in that development how the political leaders are feeling about not granting increases. So the fact that South Africa is not printing money to cover its COVID package, but that it is going to international institutions like the IMF and the World Bank and so on for probably around about 95 billion rand. It depends a little bit on the exchange rate. We're looking at about $5.2 billion. And depending on the exchange rate, that translates into somewhere between 90 and 100 billion rand. I think it's indicative of government's fiscal and monetary conservatism. The other thing which goes back a little bit before the COVID pandemic is the strong emphasis the president has put on investment. Ever since he became president in February 2018, and in April 2018, a few months later, he launched his investment drive. He appointed investment envoys. He said that there will be an investment conference. We had a second one in 2019 and so on. So this has been a big priority for the president. It hasn't rendered the results yet. I'll show that to you now, but it tells us where the president's head is. And then what we've also seen in the last particularly 18 months is where the government's head is in respect of energy and electricity in particular. And I'll spend some time on that this morning because I think it's going to be a big game changer for South Africa. So how do we get out of the dwang? That's really the point. And as I'm trying to argue, let's look not at words, let's look at actions. Actions are more reliable. The first one is the president has made a priority of investment. We haven't seen the results yet. In 2018, the first year that Mr. Ramaphosa became president, we invested in South Africa 18.8% of GDP. Think of it as 18.8 cents in the rand, every 100 cents. was invested into the economy, and that number has declined almost by 1% to 17.9% in 2019. So the two investment conferences that the president has had, the investment envoys that he's appointed, his strong harping of that theme has not yet translated into cash. Well, not more cash. And I think it's important just to take note of that. There is a little bit of a bigger story here. We've seen a 10-year decline in investment. In 2009, which was Mr. Zuma's first year in office, we had an investment rate of 21.5%. So we've come down all the way from 21.5 to now 17.9. It is a substantial decline. It's a long-term decline, and you will need to work very hard to reverse that. Just as a matter of interest, you know, what are percentages, what are numbers? That 17.9% of GDP in 2019 was still equal to more than 980 billion rand, just short of 1 trillion, or to put it into ordinary language, 103 million rand per hour, 24/7. This hour, more or less, this webinar has now been going in that hour, 103 million rand was invested into the South African economy on a gross basis. Gross simply means before you deduct depreciation. So obviously, a lot of it is replacement, absolutely, but that's also important because through replacement, you get new technology, you get higher productivity, you modernize things and so on. So just to give you a feel, you know, I always say a country that's investing that kind of money in itself is not a country that's just going to fall over. That is a misunderstanding of what's happening in our society. The second thing that the president is increasingly pushing is infrastructure, and it was his idea to come up with an infrastructure pipeline and with an infrastructure fund, rather, my apologies, and that fund has to set up a pipeline of projects. In February this year, that pipeline came to 700 billion. A very, very competent civil servant, Sean Phillips, who's an engineer, was appointed as the CEO of the infrastructure fund. And the purpose of the infrastructure fund is to mix public and private money. The term that everybody wants to use is blended finance. So you use money from the private sector, money from the public sector, mix the two together, and you enable the infrastructure fund to do projects which otherwise may not be bankable. And here I think we're going to see an interesting development, and we've seen it in the last few days with the most recent announcement last night. The way I think the infrastructure is going to work is government is going to close a social compact, negotiate and agree an agreement, a social compact with the savings industry of South Africa to participate in the infrastructure fund and help to build infrastructure and to develop the country. You will see there, I've got it in brackets there. I don't think we're going to see prescribed assets. Now, that's always a dangerous thing to an analyst to do, to make a specific prediction. But I'm fairly confident about this prediction. If you connect all the dots that we have, then I think the savings industry, the pension fund industry is going to come to the table on their own volition and on terms that they can live with and use the savings of the country to do infrastructure. So, the third area where I think the government has already shown their hand and has told us what they want to do is in energy and in telecommunications. I'm not going to say much about telecommunications, except to say that the evidence from all over the world is that the more bandwidth people have, the more the economy grows. The stronger your bandwidth, the stronger this webinar this morning will be. Your sound will be clear, the video will be clear, and it will be as if you're sitting in the room. If you don't have a strong internet connection, that won't be the case. So the better quality product, the higher productivity that comes out of being connected, it's a foregone conclusion that will give you economic growth. And those of you who follow these matters will know that the minister has made the necessary policy pronouncements. The matter is now with the regulator ICASA, and the ICASA is on their program to reach by November this year the allocation of additional spectrum. And somebody like Vodacom, for example, the other day told one of our colleagues at Nedbank Private Wealth Research how excited they are about what can happen after November. And they are quite happy that ICASA will meet the deadline. So I'm not going to talk more about that. What I would like to do this morning is to take you through the electricity scenario, because there we have a lot of forensic evidence, not just interpretation, but a lot of forensic evidence of what's going on. And to appreciate that position, you've got to go back to October last year. In October last year, two critical policy documents were released by government, and both of them, I have to say, were completely ignored by the chattering classes. They caught on a little bit later, but certainly in October, it was not there. In fact, yeah, let me make the point. And those two policy documents basically said that over the 11 years from 2019, 2020 up to the end of 2030, that's 11 years, and I know it sounds like 10, but it's 11 years, 30,000 megawatts of new energy capacity will be installed in South Africa. 30,000 megawatts of new energy capacity. A huge portion of that, 11,000, is coal-fired power stations that will be decommissioned, that will be closed down. And what do you replace them with? And there you can see on the slide the percentage provided for in the government plans of what will come in the place of coal. Wind is 48%, solar 20%, gas 10%, hydro 8%, storage and coal 5%. Now, I think it's safe to say this morning, I don't think that 5% for coal will materialize. It's in the government's plan, so the coal industry can't say that they're being shut out. There are also, I think, certain contractual issues there. But if you look at it from an environmental and a financing point, I don't think it'll be 5% for coal. So that 5% will have to be added on to one of the other categories that you see there. And also, just to give you a full picture, the 8% for hydro is dependent on the big Congo River scheme in the middle of Africa. And the government's plans clearly states if that cannot be put into action with certain preconditions by 2022, then hydro will be scrapped, because that's where it comes from. It's the Great Inga scheme, and that will be replaced with nuclear. So just bear that in mind when you hear the word nuclear. It fits into that 8% for hydro. So to install 30,000 megawatts of new generating capacity in South Africa, most of them coming from renewable energy, is a big game changer for South Africa. And if you look at those numbers, then you can understand why I've always been skeptical about the allegation that Gwede Mantashe is a stumbling block to new energy, renewable energy, that is adhering to coal only, and so on and so forth. You just look at the hard numbers, and it's clear what his political agenda is. He drafted these government plans. It comes from his department. Now, what we will end up with in 2030 is an energy landscape that will be completely different. At the moment, more than 95% of our energy, our electricity rather, is generated by coal. You can see then that number will go down to 60%. Renewables will by then form 25%, hydro 8%, if that comes off, a little bit of nuclear, and storage 1%. Coal is on a sharply declining trend. These policy measures have all been approved by the Minister. He's gazetted them in terms of Section 34 of the Energy Act, so it's in the Government Gazette. They are now with NASA for concurrence, and NASA has already started the process. I think towards the end of the year, we will see. My view is that the bid window 5 will open by November this year. Then you will use the bulk of 2021 for financing agreements, negotiate with the banks, draw up legal contracts. It's a complicated business to do power procurement, and I would expect shovels on the ground and concrete on the ground by the end of 2022. So the big story here is the fact that Eskom will go from almost, not completely, but almost a monopoly supplier to a supplier of less than 60%. and coal even more so. Now, here I want to just draw your attention to the Eskom story because it tells you something, I think, about government. In February 2019, so it's now about 17 months ago, the Eskom, the president rather, announced in his SONA speech that Eskom will be split into three. At the time, this was completely dismissed by the chattering classes. The chattering classes said it's not an important decision. The only thing that matters is load shedding, and this splitting up is going to do nothing for load shedding. Well, in the short term, of course, that's true. We had load shedding, and the splitting up in itself is not doing anything for load shedding. But that is to walk through the forest and not see the trees. And those people who were a little bit better informed said, yes, it is an important announcement, but it will never happen. Political interests, commercial interests, trade unions, workers, and so on and so forth will torpedo this, and it won't happen. Well, in February this year, in other words, more or less precisely a year after the president made the announcement, what are we finding? We're finding in February that the chairman of the ANC and Minister of Energy Minister Gwede Mantashe, says there is no longer an argument. There is no longer an argument about Eskom being split up. And it seems to me he's right, because the trade unions, with the exception of one, have dropped their consistent resistance. They have started to say, the Secretary General of COSATU has started to say, we can't ignore facts. We have to look at facts. Now that tells you that a hell of a lot of work has been done behind the scenes, out of the public eye, by the ANC and its partners on the trade union movement, on workers to come along and buy into the Eskom rationalization story. That was in February. Since then, we've had Mr. Andre de Ruyter, the CEO of Eskom, talking in various fora on Eskom's future and pushing the line very strongly about what the president outlined in February 2019. One of the goals that had to be met was that Eskom must have 3 different boards, 3 different management teams by March 2020, and they must start running the entity as 3 separate entities, although still all part of Eskom. And that was actually, that date was achieved. The functional separation is now happening. And one of the things that is now on the go is you've got to take Eskom's huge debt load and allocate it to these 3 entities. And that's another step in how you deal with the Eskom debt, and we can talk about that. I'm not going to deal with the debt now, we don't have time. The second thing that came out of the October papers last year was that Eskom should be legally separated by 2021. In other words, more or less a year from now. I think it's now quite clear that that was a grossly over-optimistic goal by the Department of Public Enterprises, Mr. Pravin Gordhan's department. And I say it was grossly over-optimistic because just look at Old Mutual and Investec. Old Mutual reorganized itself, and from the date of the announcement to the date of implementation was about 3.5 years. In Investec's case, I believe it took about 5 years to separate Investec and what is now known as 91. These are big organizations, they're complex organizations, and taking them apart and then putting them together again in a way that they can function is not an easy exercise. So I'm not concerned at all by the fact that the 2021 deadline is now standing at 2023. It's only 3.5 years away, and what you will have at the end of the 3.5 years is the end of Eskom's monopoly on generation and distribution. And I don't think one can overestimate that. So the Eskom story for me is a really classic example of how the chattering class has missed a major policy direction by the government, and then how we all have missed our government systematically put this thing into place. In the time that I've been privileged to serve on the National Planning Commission, I've been fairly close to the bureaucracy. In this public service, things take time. That's just the way it is. It takes time. You've got to consult. You've got to listen to comments. You've got to respond to comments. You cannot just barge ahead as if you're in a private company. And that's something that we must bring into our expectations and calculations. I just want to make one point, and that is that I would expect the biggest winner of South Africa's change in energy supply will be the gas industry. And it's quite clear that one of the things Mr. Director wants to do is to take the old Eskom power stations in the Mpumalanga province, the ones that are being decommissioned, and convert them into gas stations, with the gas being imported from Mozambique by pipeline. That's the plan, that's the vision. And I think it will come off for the simple reason it is much easier to refit an old coal-fired power station than what it is to build a new gas power station. So the gas is going to be a big winner in the changing landscape of energy. Now, let's just quickly talk about money, because that is what really counts. This discussion here today is about how do we get out of the twang, how do we get our economy to grow again. And for that, you need investment. We've seen that the investment results have not come through yet. So let's just play a little bit with the money. That is what needs to happen. You've already seen that first bullet. That is what is envisaged in the integrated resource plan of how South Africa's energy industry must develop. Now, that is based, and that provides for 30,000 megawatts of new capacity, just to repeat that point. Now, the second bullet there you see is a reference to a thing called EAF. What is that? EAF is energy availability factor. It's a measurement of Eskom's efficiency. Now, the integrated resource plan that provides for 30,000 megawatts of new capacity to be installed is based on the assumption that Eskom will run at 75% efficiency. And there's no ways that is or can happen. Currently, Eskom is running at about 67%. Now, from 67 to 75% is a huge, huge gap. The plant is old, maintenance was too poor. Eskom is not going to get above 70. On that, I will put a case of good South African red wine this morning. Now, if you can't get to 70 or 75% efficiencies, you will have to install more than 30,000, 33,000, 34, 35. That's the first point I want to point out. That we will in all likelihood need more than the 30,000 which is currently on the table. Now, how much money is that? Well, the 6,000 megawatt of renewables that South Africa has installed, or procured rather, installation is still carrying on to date, cost 220 billion rand. That's for 6,000 megawatts. By the way, more than 40% of that money was foreign investment. So clearly, not just locals, but also foreigners are quite interested in coming into the South African energy industry, putting money here, and of course, getting their return over time. Now, if 6,000 megawatts require 220 billion rand investment, then 30,000 megawatts will be at least 1 trillion rand. You must provide for the fact that technology becomes cheaper and it becomes easier, and the more you do it, the more efficient you become. So the number will fall. But on the other hand, you've got a depreciating currency and you've got more than 30,000 probably to be bought. So I think to talk about 1 trillion rand over the next 10 years is not out of range. It is not out of range. And if you then just do it back of a cigarette box calculation, 1 trillion rand over 10 years gives you 100 billion rand a year. Now, earlier in this presentation, I showed you South Africa's gross investment, which last year was about 18% of GDP. Now, the late Deddy Keys told me that one mustn't look at gross investment. That's what the economists do, and that's fine for economic analysis. But he said, from a businessman's point of view, you must look at investment after depreciation. And I fully buy into that Keys mantra. And in the last 2 years, we invested 18%, which I told you was about 900 billion rand last year. But our net investment, after you deduct the depreciation, is about 200 billion rand a year. Again, quite a few million rand per hour, just to bring that perspective. In the 7 years before the last 2 years, our net investment was running at about 211 billion. And now you can see the enormous impact. If you are spending 100 billion rand of new investment on a base of about 200 billion, you're expanding the capacity in the country quite considerably. And that should give us quite a growth kicker. There's no question about that. There's also a lot of other spin-offs. You may have heard the ANC talking a lot about localization. One of the things where there's huge scope for localization is to build the renewable energy parts here in South Africa. You know that there was a factory in Durban, and that factory closed down because the old guard at Eskom, the Gupta guard, torpedoed that whole thing. Those kinds of initiatives can now come back, and businessmen can start planning on the picture as you see it on the screen. So to conclude this, Bruce, what then really are we saying? We are deep in the bang, literally the worst since 1921. The 100 years is not just a figure of speech. It is that is what the numbers tell us. If we want to grow, the best growth can happen in the release of spectrum and in energy. And energy in particular will be a big increase in investment. It is such a capital-intensive industry. You have to throw money at the problem if you want to install capacity. And the nice thing about electricity, and to some extent spectrum, you do not have to create a demand. You do not have to convince people to switch from meat to vegetables, or to switch from meat to chicken, or not to buy maize but buy something else. People want electricity. They need it. They need it. The problem in the country in South Africa is not that we don't have a demand, it's that we don't have supply. So if you can just supply the supply, you will find that there will be a return on investment. And I think that in my estimation, and this is just a scenario, can help to get us out of that 6-year demographic, excuse me, out of that 6-year demographic recession. We can go back to a growth rate of 2.5%, maybe even 3%. And that is more than enough to cover 1.5% population growth. You grow the economy at 2.5%, 3%, you grow your people at 1.5%, you've got 1.5% extra surplus to play with. And with that, we can end the 6-year demographic recession. Thank you very much, Bruce.
JP, thank you. Becky Kayla just called, answered my phone. Sorry, I missed part of your presentation. And he said, if you're doing back of the cigarette box calculations, please could you see the receipt for the cigarette box? Because what you were doing is not legal. Anyway, now onto the Q&A part of the question this morning. I mean, we are in deep trouble. There's no question about it. Let's go to you, Janca, first, because I just want to make sure that you're still awake if you haven't got all complacent on us. Just give me that perspective on JP's presentation. I mean, JP is a guy who looks at so many different data points. I mean, there is an underlying optimism embedded in the reality of the crisis that we face in what JP is saying this morning. Can you concur with his slightly more optimistic view than you might see elsewhere?
I think, Bruce, it goes back to that, what I said in one of the slides, which is never let a good crisis go to waste. If there's ever an opportunity for South Africa to be decisive about reforms, which has now been so well documented, and I think there's a difference between the structural reforms that need to happen, which they've been in place for a very long time and they will take longer to resolve. Things like education, things like transport, things like rebuilding society. But what JP highlights, which I think one can be, and the way he's nicely laid out some of the facts, is there are some low-hanging fruits which people have been speaking about for a long time, such as spectrum, such as infrastructure, such as electricity, which without those things, you cannot get the economy to grow again. But at this stage, we have an impressive springboard, and a lot of work is actually happening in the background. So if we can get some of these low-hanging fruits and get some of the reforms up and running that JP talks about, part of our fiscal problem isn't only an expenditure problem, it's a growth problem. And those things have a very direct impact on investment and on growth and productivity growth. And I think those are the things that you need to solve not only the debt problem, but to also demonstrate to the rest of the world that you are taking these reforms seriously. And as I said, there's no easier way to get your interest bill down than to decrease the risk in your country and get growth going again.
Also for you, Janca, lots of questions around equity markets and the huge surge that we've seen, this extraordinary V-shaped recovery in markets, which is not at all replicated or reflected in the economies that the markets are supposed to represent. And one of the questions says, is this speak more to wealth inequality perhaps than it does to economic performance? Others asking whether or not this is this a sustainable recovery? Is this the dead cat bounce? Or do we wake up one morning when markets finally realize that economies are lagging expectations, and suddenly we go back into another sharp downturn? I mean, the last 24 hours of markets have shown that the vulnerabilities of the huge gains we've seen in the last couple of weeks.
Absolutely. To your earlier point, the prices and the moves have really defied gravity. In our minds, some of the opportunities actually on a stock specific basis that we took in the US market, the rally has been so extreme that we were able to enter positions and also exit them within a couple of months. And I think that reflects a couple of things. Number one, I think there's room for disappointment. We're starting to see that the idea of a second wave of infections is very much real, and it's happening around the world. And there's no doubt that these things will impact earnings. My own view is that I also think people do underestimate the recovery in demand. We're seeing the headline numbers in terms of unemployment in the US, but much of that is furloughed workers and people who've been put on temporary unemployment. We don't know exactly whether they will be able to go back to a job. At this stage, we're assuming, but if this lasts for much, much longer, and if the vaccines that we're working on, if the treatments that we're working on don't deliver by the end of this year or start of next year, as many people expect, then I think there is room for disappointment. And just the other thing to mention is, and I think it's critically important, that this idea of an uneven recovery is very, I think, something we should keep in the front of our minds. Because yes, if the tech market rallies, the S&P 500 will rally, the Nasdaq will rally, and the MSCI World will rally because it makes up the biggest proportion of that. However, if you look at the rest of those markets, they haven't nearly seen the same type of recovery in prices that we've seen from some of the other sectors, because the uncertainty there is much, much greater. You only have to think of something like discretionary retailers. For the foreseeable future, if you're under pressure, you're much more likely to favor your grocery shop each week than to go out and buy a new pair of shoes. And so we have to be mindful of those things. So I think cautious and make sure that the price you're paying for something is the right one and includes all of these risks that we're talking about.
Thank you, Janca. JP, I've got lots of questions and we'll sort of bring them into one big ANC question. And there's lots of concern, of course, about who's really running the country. And there is lots of speculation as to whether or not Cyril Ramaphosa's got his hand firmly on the tiller, whether or not he's being manipulated and played. And we've seen lots of speculation around that, of course. Questions as to whether or not his position as president is secure, if a position like that is ever secure. Is he more secure now, perhaps, than he was 6 months, 12 months, 18 months ago? Maybe that's the best question.
Yeah, I have absolutely no doubt about that. In the May newsletter for Nedbank Private Wealth clients, we've done an analysis of his political position, and we quoted various opinion polls and so on. I don't want to go over that ground again because it will bore clients, but the answer unequivocally, in my view, is yes. He's much, much stronger. Just look back. 2 years ago, a little bit more than 2 years ago, he was elected president of the ANC by a margin of 52 to 48. By no stretch of the imagination, I think, is there anybody that will argue that he still stands at 52 to 48. Everything that you see indicate that he's standing stronger than that. Now, is he at 80-20? Is he at 90-10? Is he at 70-30? About that, we can have a conversation. But we can't have a conversation to say that he is still at 52-48. Absolutely not. A couple of things has happened. First of all, the big ogre of Mr. Zuma has just disappeared like mist in front of the sun. Everybody talked about how Zuma will do this and do that and manipulate this. And as we would say in Afrikaans, kyk hoe lyk hy nou. Kyk hoe lyk hy nou. Secondly, what happened to people that can run against him? I think Mrs. Zuma has not done herself any favors with the media conferences that she handled as Minister of Copper. No, I think Mr. Ramaphosa is absolutely safe in his position. If there's no health issue, then I think he will complete 10 years as president of the ANC and 10 years or 11 years effectively as president of the country. And I think his position will grow. Look how quiet Julius Malema has become. Look how quiet Ace Magashula has become. No, there's no question that he's in charge. I know people want to talk a lot about the cigarette issue and so on. Excuse me, my apologies, Bruce.
Okay, I'll let you give you a moment to clear your yeah, because I mean we all know, those of us who've had small children in the house, that when the house goes quiet, that is the time to panic because the children are playing with matches. Should we be worried politically from that perspective? Because when politicians go quiet, we don't know what games they're playing. At least if they jabbering, we get a better idea. JP?
Yeah, but if they're jabbering, for example, on cigarettes, then we also say Cyril is not in charge. No, I think all the signs from the body politic tell you, look, COVID has done a lot to silence his opponents. So COVID has done a lot to focus the attention. COVID has done a lot also to underline the seriousness of our economic malaise, but also the seriousness of our social malaise, of poverty and inequality. I mean, can you imagine that we live in a country where people are queuing for foods kilometers long, but we're spending or have spent 21 billion rand or something on SAA? Clearly, that kind of nonsense has to stop. And I have no doubt that cutting off the oxygen of money supply to a lot of people, that is also helped to quiet them down. Now, I'm not concerned at all about his political position.
Yeah, I mean, let's talk about the big, bold ambitions that often political parties have and governments have, and certainly the South African Airways on life support and the very slow progress we see in the transformation, the economic transformation of state-owned enterprises, and this continued and quite tedious desire of the ANC to put itself at the center of the economy, when actually what we're seeing is far more public-private partnership and far more collaboration happening in the real world. Sometimes, and it's hard to do, we have to drown out the noise.
Yeah, you have to drown out the noise, and you've got to look beyond the noise, and that is not always that easy, true. But I think in South Africa we're too inclined, if I may say so, maybe it's the same in other countries, I don't know, that we go for what I would call headline analysis. We just read the headlines and then we say this and that and the other. And I think South Africa is such a complicated country to run. And Mr. Ramaphosa has got such a unique style. He's not a P.W. Botha, he's not a Thabo Mbeki, but he's also not a Nelson Mandela, you know. He's got his own way, and his way is to plot and to stroke and to seek consensus, and at the right time to strike. And just look what he's done in electricity. We've gone from a situation where the union said absolutely never a split in Eskom to a situation where they say we have to accept the facts. Now that change in union view doesn't just happen by itself. It happens because people work at it, because people sell a vision, because they do the political work. What is politics other than to convince people of your opinion?
JP, we are out of time. Janca, one last question for you, Janca, and that is the question of printing money. I mean, we've got huge shortfalls absolutely everywhere. We've got massive fiscal deficits. We've got huge declines in government revenues. The medium-term budget, I want to call it the medium-term budget, but the emergency budget, which the finance minister will be unveiling in a couple of weeks' time, will give a better picture. But can we get away without quantity easing, as Ace Magashula would put it? Can we escape what many people on the Q&A session see as an inevitability?
I do think that quantitative easing is a very difficult option for South Africa. The Reserve Bank has made that quite clear. When you don't have a reserve currency like the US does or Europe does, it does and has the potential to create inflation within our own country. So I think there's a whole host of other options that are available to us before we get to that point. Because we should also remember that if you are the US and you've increased your debt burdens, but you're growing over and above that, and that debt is being put productively into economic growth. And as long as the growth is more than the debt servicing cost, you can actually sustain high levels of debt for some time to come. That is not currently the case in South Africa. And so it's a very dangerous game to play, one, as I said, which the Reserve Bank has argued against very strongly. And especially if you consider the point which JP made around inequality. Inflation is a very dangerous thing to try or to unlock in a country where where people are queuing for food parcels, where things get more expensive, and you can just see how that can be an absolute recipe for disaster. So I do think there's a couple of levers to pull. I mean, they did promise that we would, or they did commit to trying to save at least 160 billion from government wages, and from public sector wages. But I think it's more, JP's spoken about that, but I think it's about more than that. The unions, and there seems to be an agreement that much of that is possible, but part of that is also looking at the way promotional structures work within that, and the actual monetary implication of that, which has also added a lot to cost over the years, what they call the notch system. And if you speak to, so some of the calls that I've been on with some of the union members, they do suggest that there's a need to look across SOEs and across entities and look at the range of salaries from the highest to the lowest, and ask the questions whether the compensation across the board is still appropriate. So my short answer to conclude really is just to say, I think that there is expenditure that can be reprioritized. There's still slippage within the budget. We do have other levers to pull, and as JP said, they've been quite smart in the way that they've managed the budget thus far. We will also be getting specific help for this health crisis, which I think will go a long way. But the reality is, unless we can get growth going, and unless we can do the reforms, yeah, it's going to be and that's one of the reasons we're concerned, it's going to be a rough road. So a few low-hanging fruits, but we need to do the hard work.
Janca, thank you. I'm going to make us all stop there. Janca Steenkamp from Nedbank Private Wealth, thank you very much indeed. And also to the independent analyst, JP Landman. JP, thank you very much for your insights. And to everybody who has been on this call this morning, thank you very much for joining us on behalf of Nedbank Private Wealth. Just to leave you with one thought, time for radical economic transformation. It's maybe that time. Was it time for radical transformation of the economy? Expecting to see some interesting things coming out of what he says in the next 2 weeks when he releases this emergency budget. He will need to come up with a lot of detail and a lot of additional information in that particular presentation. We look forward to that. Until next time, thank you very much for everybody for watching, and to Janca and to JP and to the entire team behind the scenes pulling this webinar together. Thank you very much as well. Have a good, productive, is it what day of the week is it? Is it Thursday? I think it's Thursday. Have a good Thursday. Cheers, everyone.